You guys, my name is Muhammad Usman, and today topic is presented about the voluntary disclosure about the E and S and how they can impact on the ESG rating divergence. Okay, in terms of there's a lot of like climate changes, policy uncertainty, and financial crisis stuff, and which significantly disrupt the financial market in the global level. And the financial institutions, and the investors, they are worried about the sustainability. So therefore, for the firms as a strategy in order to gain the United Nations Sustainable Development Goals, and they should follow the ESG investment. So the first concept in terms of environment, social, and governance factor is initiated by the UN in 2004, and in order to harmonize and sustainable development of the environment, society, and the economy in an integrated manner. So the core of ESG investing, sometimes called socially responsible investment, SRI, and to adopt the principle of the ESG in terms of investments. So investors are encouraged to prioritize their sustainable investment under in terms of China's dual carbon policy, as the President Xi Jinping announced that. So why the E and social challenges is important according to the recent survey of World Economic Forum. So they highlight the environment and social challenges about 80% of the top 10 risk which international investor counter in the next 10 years. So Bloomberg also predict like global ESG assets about 30 trillion in 2022, and they are expected is with the size is a 10 more trillion dollar in the next decade. So ESG rating in terms of CSR or sustainability rating. So the total volume of the ESG should be like total assets under management. Total international assets under management is about $140 trillion. So is ESG also growing a lot in terms of investments? So ESG rating, which is also called like CSR sustainability rating. So it's a new paradigm to analyze the non-financial information. So ESG rating is a crucial metrics in order to assess the firm's commitment to environment and social responsible level. So as opposed to ESG rating, opposed to credit rating, so ESG rating is offered by different independent third-party rating agencies. So ESG raters, independent information brokers, so which give a quantitative rating of any firm about their ESG performance. So firm, for example, like Facebook, they may receive a different final ESG rating, and various rating agencies given that because they are using different techniques, assessment methods, and using different indicator selections, models, and weightage schemes. So that's why a firm may receive a different ESG rating from the different rating agencies which are working independently as a third party agencies. So because they have a different sources, different rating algorithm, so ESG rating provider maybe have a divergence in ESG rating. For example, the Facebook is a one company, and we have a Bloomberg rating agencies. We have a different international MSCI, different agencies. So they maybe Bloomberg give A rating to the Facebook, and the MSCI maybe give the different rating like B or C. So a same firm maybe get a different rating, which is called ESG rating divergence for a single firm from the different raters. So why there is a different? Several people they highlight the factors. For example, Berg he highlight the different factors which provide divergence in ESG rating, maybe due to the scope, measure, and weightage. But while other scholars they highlight that maybe the data imputation, data inconsistencies, and peer review selection stuff, maybe or maybe different variation in terms of methodology can due to that there is a rating divergence in ESG. So disparities in ESG rating standards among different institutions, they call inconsistencies in ESG rating, which possibly may be misleading the investor about the true picture of the ESG performance of the company, and also may lowering their stock demand of that company. So divergence raises a concern for regulators and also for the investors, because due to these uncertainties or divergence in ESG rating, they have maybe impact on the stock return, volatility of the stock, and availability of external funding, and maybe also increase the effective beta and kappa alpha levels of a firm. So therefore, lead to uncertainty, additional expenses for the investors, and hamper management decisions, thus lowering firm motivation to enhance their ESG performance. So how we can different scholars can question about ESG rating divergence in recent years. So we can see several consequences if there is a rating divergence about ESG, which is issued by the different agencies. Well, in terms of ESG disclosure, in generally the world, many countries they are using the volatility information disclosure about the ESG or CSR. But now a few countries they also implemented the mandatory disclosure. So, in terms of a recent report of the CCXI, they are showing that Chinese listed companies, they are about 34%, signaling a rise in terms of the ESG reporting, which is effectiveness of such disclosure, conveying, mitigating, or reducing ESG rating divergence in the academia is a hot topic now. So existing literature provide that ESG disclosure act as a tool for managers and also enhance firm ESG engagement. Other studies highlight that capital market consequences of this disclosure, like impact on firm value, access to public debt, stock liquidity, green bond issuance, and ESG investment, or like stock price efficiency and financial performance. So these are some financial or capital market consequences in terms of ESG disclosure. So voluntary disclosure in terms of they can reduce information capability and hampers efficient data mining, and also improve disclosure quality and mitigate rating divergence. So different conclusions about like potential impact of voluntary disclosure on harmonizing ESG ratings and also addressing the multifaceted challenges posed by divergence in ESG assessments. So, in terms of some empirical evidence about the firm's voluntary disclosure about environment social aspect efficiently mitigate ESG rating divergence, recently evidence in the Europe, and therefore increase this voluntary disclosure about E&S. They also increase transparency, positive signaling, and alignment of the interests, and aligns ESG disclosure more closely with the actual ESG performance of the company, which reducing misalignment and information asymmetry. So if there is a voluntary disclosure, there is a chances of transparency, alignment of the disclosure and performance gap. So we also argue like in terms of the three public attention sources, like from financial analysts, media coverage, and institutional investors, they can help to mitigate this effect as in terms of because they provide some supervisory role and information. So we say these three public attention sources also can moderate between the connection between the nexus of voluntary disclosure and ESG rating divergence. And therefore, institutional investors and media analysts, because they serve as a check and balance, reducing the discrepancies between disclosure and the performance, actual performance. So therefore, there's a chances due to these public attention sources, they can help in mitigating the divergence effect. So in terms of developing some few hypotheses, so I'm making some concise stuff. So we think the quality of disclosure can also help, like a high quality disclosure can help in comprehensive, accurate, and transparent the information about the ESG practices. and low quality is vice versa. So external assurance from the third party like Big Four or top 10 auditors, accounting firms, they can help us to mitigate the ESG divergence stuff. And in term, we also check the if the firms are following the Global Reporting Initiative (GRI) guidelines. They can also help us aligning the rating stuff. But we also see the connection of greenwashing. So if there's a greenwashing behavior, so how they can help or mitigate or maybe determinal impact on the connection between these two. So here's a list of hypotheses. So first we check that how the voluntary disclosure in China about E and S, environment, social, how they can mitigate divergence in ESG rating. Then how public attention from financial analysts, or media, or financial institutions, or institutional investors, how they can play a role between this nexus. And third, we can also see the mitigation effect of voluntary disclosure in the if the quality of disclosure, how they can mitigate, and how the external insurance play a role between that, and how the greenwashing behavior of the firms, how they can play a part between this nexus. So here's our contribution towards cell literature in terms of accounting literature about the corporate non-financial information disclosure. So this study is the first one in the Chinese context because recently we have one study about the European market, the few firms about the index, but we have a data of the Chinese stock market. So this is one stuff, and we also check the endogeneity stuff in terms of PSM and uh, IV variable, instrumental variable placebo test. So second, we also using the moderating effect of the public attention in terms of three different public sources and how they can play the effect between these two. And third, we can also check the quality of disclosure, how they can strengthen this mitigating effect. If there's a high disclosure quality, the disclosure good, how they can affect, and if there's a greenwashing behavior, they can give a negative impact between this nexus. And lastly, in terms of theoretical stuff, in terms of legitimacy theory, information asymmetry, or signal theories, we also argue like public attention from different sources, they can impact to mitigate this effect. And in terms of methodological part, we can see we have sources of different data set from the Chinese stock market. We have data about more than 3,000 firms listed in Shanghai and Shenzhen Stock Exchange from the 4 to 5 years. And data about the voluntary disclosure, we use the CSMAR and Bloomberg in terms of robustness stuff. And rating data, we use the 6 Chinese rating agencies. These are our primary variables like rating divergence and disclosure. And here's our model. And we use descriptive statistics. And here's our primary relationship. Like if we have an environment and social disclosure, they can mitigate the divergence stuff between the rating agencies. So they can help. The voluntary disclosure can help. And we can also use the industry year and different fixed effect models as well. And our result is reversed. So in terms of PSM, and we can still see 1:1 ratio, we have still have a significant effect. Our result is robustness. And in terms of 2SLS, we can see still our in the second stage we have a robustness of our funding, and we use two different proxies, HS 300 as an IV and industry average environment as an IV. And in terms of further robustness, we can use the lack of each variable, and still our results are hold. And in terms of we use alternative proxies, and we still see if we use the alternative proxies of both disclosure and divergence, we still have a significant result. And in terms of public attention, we see all got a significant impact. They can help out to mitigate the effect between these nexus. And the disclosure quality, high disclosure quality also impact between these connections. And okay, the last one is external insurance from the big four companies or domestic 10. they also can impact to improve the connections. But the greenwashing behavior, the last one, they can put the negative impact between these connections. Okay, here is a quick conclusion about the paper. Like voluntary disclosure can significantly impact on the rating, the firm disclosure on environment, social impact, and they can mitigate this impact. And we use the different statistical method and also use heterogeneity analysis, and we find this voluntary disclosure can reduce ESG rating divergence, especially for the firms with higher external attention and disclosure quality and external insurance. So on the other side, if the quality of the disclosure is compromised and greenwashing behavior practices is high, then these divergences may be increased, the gap is increased. So here's all from my side. Thank you so much, guys, for listening.
Hey, Muhammad. Thanks for your presentation regarding ESG, voluntary disclosure and ESG rating divergence. So I have one question that I wanted to ask regarding the paper. So the paper suggests that high quality disclosures can reduce ESG rating divergence. In your opinion, what are the key elements of a high quality ESG disclosure that firms should focus on to ensure transparency and accuracy?
Sorry, I don't understand the question. It's like quality of disclosure, right?
Yeah. So technically, we are going to basically have the accurate, right, and kind of transparent report as well, right? So based on your paper, what are the key elements of high quality ESG disclosures that firms should focus to ensure transparency and accuracy?
I think the transparency is more important in terms of they can help us, the companies or even the rating agencies. If, for example, I put a different way, like I also check the quality of disclosure in terms of internal factor and also external factor. If there is a public attention from the outside, like there's a huge percentage of institutional investors that in the company shares, and there is a media attention in terms of financial analyst or media social media coverage stuff, they can put pressure or they can help to mitigate the difference. So the quality in term of we can also say the external factor also important. About my study, external factors also play a role in term of mitigating this effect. So I think the external assurance from the big four companies, that's also a key factor in terms of quality. So because basically there's a divergence in the rate ESG performance issued by the different rating agencies. There's a gap. So we need to provide them more information. If there is external auditors, if there is external supervision from the public attention, more attention, then they can help to publish more data of the company. So if there's a more data of the company, then the rating agencies, they get more data, they can match their interest, their methodology may be comparable, so the divergence is low. If the companies are voluntarily publish their ESG information, then the gap between the divergence is low. Because what is divergence? The rating agencies from the different of the part of the world, they issue rating about one company, right? So hope you got my point.
Fantastic. Thank you so much, Mohammed, for your presentation and for your question.